Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Max Wasserman, co-founder and senior portfolio manager at Miramar Capital, to discuss opportunities in dividend investing and how investors should be identifying opportunities in today's market. Max, it's great to have you with us. Welcome to Trade Talks.
Thank you so much for having me.
You got it. And valuations are high and markets are volatile amid economic uncertainty. How should investors be identifying opportunities in today's market?
Well, I think the first thing they need to realize, are they investors or are they traders? So if they're true investors, they should be looking longer than the next 1 to 6 months about what the Fed's going to do, monetary policy, inflation. They need to look long-term, 3 to 5 years. That's how we look at investments. And when you look at an investment from that point of view, you're going to ride a full economic cycle. So we're looking at companies that have strong dominant market positions, things that we understand, good cash flows, and pay us a strong dividend. Because dividends will allow you to ride the ups and downs and still receive some income while you wait for the market to get better. But if you look short term, then you're always going to be whipsawed by the volatility in the markets. Every piece of news is going to whipsaw you in and out of the market, and you're going to be basically holding on for dear life when the market has bad information. But as an investor, you'll look for the volatility as an opportunity to find good companies that have been mispriced.
So why are dividends attractive in this environment? We know that it is an income component, but do these companies tend to be more fundamentally strong?
Well, I think when you look at a company, it's strong capital allocation. And usually when they deploy capital, sometimes it can be a good project or a bad project. But by giving you cash flow back, that gives you ability to have partial of your return now. And it's not up to the companies to make investment decisions whether they're going to buy a project or not. We like that. We like our cash in our hands because in a rising interest rate environment, basically you're able to reinvest at a higher interest rate. Now, a good company who have stability in earnings, they usually have a dividend policy because they've been around for a while and they have more predictability in their earnings. So you're right, they're more stable in earnings typically, have more stable capital allocation policy, and you can have some predictability. And that predictability is key in volatile markets.
What type of dividend stocks are you buying and how are you diversified across sectors?
Sure, we look at usually from sectors about 5 to 7. We look at technology, healthcare, financials, but we're looking for companies. Our target average on the portfolio is about 3%. That's the dividend yield on our portfolio. And we're looking for a growth rate of about 5 to 10% on that. So we're getting a mixture. We're getting healthcare companies that are basically paying you 3 to 4% in yield. They're increasing their dividends. We get cyclical companies that are paying you anywhere from 2 to 4%. Technology can be an area for capital increase and dividends. So we're getting a variety. But we want to be diversified, and we try not to hold more than a 5 to 6% in any one stock, and we try not to overweight one sector by more than really 20, 30% of what the S&P weighting. That way, we're not really too far out of the tone with the market.
Max, you had mentioned in the beginning, and I think this is a great point, that the first thing you need to establish is if you're a trader or an investor. Why should investors not try to time the market?
Because it's a futile attempt. You may get it right once or twice, but the problem is when you buy a stock, to make money, you got to buy it low and you got to sell it high. And you're going to have to pay capital gains for those accounts who have it. It's a futile attempt to be consistently trying to time the market. But an investor has an advantage over the trader because they can average into the market during volatility. They can take a really good company that they like and use any sell-off in it to add to their position. And when markets get overvalued, they can always trim something. But the key thing is not to be whipsawed by the day-to-day media, because everybody's reacting to information and they're trying to make long-term decisions based on one data point. Taking a longer-term point of view and looking at companies as truly an investment, not as a trading vehicle, you tend to make much more money in the long term.
All right, Max, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.